We have a great question from Wayne asking what exactly the revisions to economic data, what does it mean, and whether they really matter in our trading at all. So thanks for the great question, Wayne. Now, when looking at economic data, they can be revised for a couple of different reasons. The first revision comes down to possible changes in the way that the agency maybe collects the data, or it can come from a change in their methodology, or perhaps a change in the metrics that they use to measure, or change in the way in the way that they calculate the data. All of these types of changes will, of course, affect the past data after the changes has been made. So just to give you a quick example, I believe every 5 years or 4 years, I think it's 5 years, the BEA, which is the Bureau of Economic Analysis in the US, will do a complete overhaul of the way that they measure GDP or of their GDP model. So they will basically go through a review of how they measure the growth in the economy, as well as including more accurate base data for the prior numbers. And that can, of course, alter all of these subsequent GDP numbers. Then you might also get revisions due to things like seasonality, seasonal factors, which might cause some data points to be revised. And then, regular economic data is also revised for the simple reason that more accurate and more timely information has become available. So, giving you a quick example, the infamous NFP or non-farm payrolls data is usually released the first Friday of every month. Usually, sometimes it can change. But keep in mind that the data we get on the NFP on that first Friday of every month, that data was actually compiled up until the reference week. And the reference week is usually only up until around the middle of the month, normally the 12th, around there. Now, even though the BEA tries to be as accurate as they can with collecting the data, there are always going to be more detailed information coming in later that isn't part of that official release. So the data that we get for most economic indicators, whether it's GDP or PMIs or NFP, for example, they all essentially have, it's a very good estimate of what the number was based on, but it was based on partial data that they received at that time. And that can, of course, lead to revisions later on. And that's why you see revisions to some of the data that we receive every week or every month or every quarter or every year. So, take today as an example. Today we had the release of the weekly initial jobless claims data. We can see that the prior number came in at 898,000 or 898,000, and we had a revision down to 842,000. So usually the revisions aren't that big and fairly close to the prior, as we can see here. But obviously that all depends on the type of partial data that they had at that time, which means that sometimes there can be sizable revisions in the data. Now, the question on how to use this in our trading, it all depends on, firstly, the size of the revision from the prior, but also, what the more recent or headline data for that particular event was versus its expectation. So that's always going to be the market's first focus, right? So what is the actual data right now versus the expectations for this one? And then they will look to the revision. So again, let's take today as an example. Not only did we come in below the market's minimum expectation, so they expected 800,000, but we came in at 78.7, which is a positive number. Not only did we come in below that minimum expectation for the headline number, but we also had a sizable revision lower from the prior number, which was also a positive. So we basically had two positive, which means that this was overall a very positive beat in initial claims. Whereas if we had, for example, a solid beat on the headline, but this number came in at 980 or over 1 million again, that would have been actually seen as a negative. And that can either see the opposite reaction than what we expected, or we might see just no reaction at all because it's more of a mixed picture. So what sometimes can happen is you can see algos reacting to that initial beat on the headlines. You'll see a pop high in risk assets, for example. And the moment everybody realizes that, the revision is actually at 1 million, then you see a quick reversal of that move. So you always need to be very careful watching both the headline, how that obviously firstly comes in line with the expectations and the minimum and the maximum. And then you point your attention to the revisions, seeing how much of a change that is and whether that impacts the overall impact that you can expect from that headline number. Think about it this way, right? Another good example of where revisions matter more is where you are working with very important levels for specific indicators. So a good example of that would always be your PMI. So that 50 level is very important for diffusion indexes like PMI. So above 50 normally shows industry expansion, and below 50 usually shows industry contraction. So imagine that on a prior month, so say let's say last month, we had a print of that came in at 48, so in contraction territory, and it dropped from 51. That would have been a negative for that particular industry, because it means that we dropped from expansionary territory into contractionary territory, which was negative. Now imagine that the following month, or this month, we see the PMI, the new one, coming in at 50, which is a positive. But now also imagine that at the same time we have a revision that showed that that prior 48 number, which was negative, is actually a 50. That would be a double positive on the headline, as well as the revision. So always make sure to check what happened to not only your headline as well as your prior and that revision, but making sure that you pay attention when it's around very significant levels for indicators. Another good example is looking at inflation data. If you know that a central bank's inflation target is at 2%, and you had a print at 2.1, and that's a lot of upside because it points to possible tighter monetary policy. And then the next month you see, you come in maybe at 2%, which is below 2.1, but then you see the prior was reduced from 2.1 to 1.9. That would be an even bigger blow to that particular one. And of course, then keeping in mind when it's a mixed picture, as we said, if you have a beat in the one and a miss in the other, that's more of a mixed data point and probably not something that you want to be risking on and trading. Are they always important, these revisions? Not really, but they can be important. They can be very important, but it all, again, comes down to the context and what they mean as part of the bigger picture, what they mean as part of the overall sentiment for the currency, the fundamental bias for the currency, the expectations, or the actual versus the expectations, just as an example. So I hope that helps with the question, Wayne. Any other questions, please don't hesitate to let us know.